So, hi guys, welcome back. Today we're going to be doing a comparison between some of the biggest solar companies on the market right now. We're going to be looking at Enphase Energy and First Solar as well. As you can see, over the last 5 years, both companies have performed extremely well. Enphase up more than almost 16,000% up over the last 5 years. First Solar slightly less, but still a very solid 162% up over the last 5 years. But recently, they both have had quite a massive drop. We've seen Enphase drop from about $267 down 33% to currently $178, and First Solar dropped from almost $120, dropped down 27% to $87 right now. So both companies have had quite a major correction over the past couple of months with the selling of a lot of growth companies. So today we're going to be doing a comparison between both of these companies. If you do enjoy, consider subscribing. It is free and does help me out a ton. If not, thanks for watching anyway. Onto the video. So just some key things to note before we start the actual stock analysis. Just to note that First Solar has a market cap of $9 billion, while Enphase has a one of $24 billion, so Enphase is a larger company. However, this would be overshadowed by Enphase PE ratio of more than 155 compared to First Solar's PE ratio of just 60, showing that Enphase, although technically a bigger company, is a lot more overvalued, and that is something we're going to be looking at in this video, not only the growth factors of these companies, but more so into whether these companies are actually a good buy at the current price that they are right now. So the first thing we're going to be looking at an article on Seeking Alpha, looking at the growth drivers of Enphase, but looking at how the expectations and whether that's priced into the valuation of the company. And this article is written when Enphase was at $186.90, and currently the stock is at $178. So you do need to take that into account as well. So just a summary of this article, Enphase is currently the market leader in the solar inverter technology with a 15.57% market share in the US in the Q3 of 2021, and the market potential for this company is still quite huge. The IQ8 solar microinverters will be of immense value to the company's business in the future, as the device is unparalleled in the industry. The company has a lot of drivers for profitability growth. The author of this expects significant growth in margin and recovering asset turnover in the coming years. However, the company is trading at a fair price and the expectations are priced in, if so slightly overvalued than where the company probably should be valued at. So the investment thesis. So Enphase Energy's results in 2021 were impressive. Despite facing COVID-related global supply chain issues, the company posted record results. Revenue for the third quarter of 2021 was a record $351.5 million, up 196% year over year, and the company's leading position, growing industry, geographic diversification, and entry into new markets will help increase the financial results for the future as well. Enphase Energy still has room for growth while already a leader in photovoltaic systems in the United States. Solar PV is likely to be the next generation of preferred energy sources. The author expects Enphase will continue to improve its profitability by further realizing economies of scale, as the company is still at the very beginning of its journey. Basically talking about how as the company increases, the value of the company will increase, and at the same time, the cost to them in distributing energy with their inverter technology and stuff like that, the cost of that will decrease over time as the company increases, which is a very good sign for the company there. Cost management was successful despite the supply chain problems, and the gross margin for Enphase remained at the same level. When the industry challenges are over, profitability is expected to increase significantly. In addition, the company has a significant balance of liquid assets, which is a hidden driver for substantial growth in profitability. However, today, the company is trading near fair market value, and the author rates this as a hold. So the company profile. So what Enphase Energy does is it designs, manufactures, and markets and supports microinverter systems for the solar photovoltaic industry. It sells these systems to various construction firms, wholesalers, and engineers all throughout the United States. And it was founded in 2006, and close to 76% of their revenue comes from within the United States. So there is a lot of room to grow internationally for this company. Institutional investors own close to 72% of the company, and a list of the main shareholders are presented below. I'll just name some of the big ones. The Vanguard Group holds almost 10% stake in Enphase, BlackRock Fund Advisors about 6.7%, Invesco Capital about 2.5%, and BlackRock Advisors in the UK hold about another 2% of the company. Total institutional investors own about 72%. So the industry opportunity. So where can this company actually go into the future? So the growing focus on clean energy and electric vehicles under the infrastructure bill will help clean energy sector flourish. This is the infrastructure bill that was going to pass in the Senate in the United States. So according to Research and Markets, the global microinverter market is expected to grow to 6.5 billion by 2025, which is a compound annual growth rate about 21% year over year. Enphase is currently the market leader in solar inverter technology, with a market share about 15.5% in the US in Q3 of 2021. Even if Enphase grows in line with the market, the company will more than double in value by 2025. This scenario looks realistic given that Enphase compound annual growth rate for the last 5 years was 30%. So even if there is a significant slowdown, even if Enphase performs exactly as an average solar microinverter company would, the value of Enphase is still expected to double by 2025, which is a very, very good sign for the company, especially when we're looking at a more conservative aspect of how the company can grow into the future. In November of 2021, Enphase acquired ClipperGreek, which introduced technology for charging electric vehicles. It is also an essential driver for long-term growth, as the potential market for electric vehicles is vast, especially growing within China, majority in Europe and the United States as well. Enphase Energy continues to strengthen its competitive positioning in the market, and the company announced its new development, the implementation of which will already begin in Q4 of 2021. So this is from their Q3 2021 conference call, where they said, yesterday we announced the all-new all-in-one Enphase energy system with IQ8 solar microinverters for customers in North America, and IQ8 is Enphase's smartest microinverter yet. Unlike competing devices, IQ8 can form a microgrid during a power outage using sunlight, which will provide backup power even without a battery, using the sunlight, which is quite an effective mechanism, especially with solar having a lot of doubt cast over it with the reliability of solar energy there. So this IQ8 microinverter will be really, really prominent in growing Enphase into the future. So their financial performance. In Q3 of 2021, Enphase reported revenues of $351.5 million, up 11% quarter over quarter and 196% year over year, with a compound annual growth rate in revenues over the last 5 years being more than 30%. Management expects end-year revenues of $390 to $410 million, somewhere in between that, which is higher than the Wall Street consensus of $374.5 million, which is a significant bump, showing the company is performing better than, say, the traditional investors are valuing it as, looking into the future. It is also worth noting that Enphase consistently outperforms its forecast, with just a revenue of $232 million in 2013. Now we're going into the $1 billion revenue in the trailing 12 months. It's been a significant increase and a very solid growth for Enphase of the last decade or so. In 2018, the gross margin was 25.5%, and the operating margin was negative 3.5%. But today, these figures are 41.5% and just over 19% respectively, showing that their gross margin has taken a big bump and their operating margin has come into the higher positives, which is a good sign for the company. And the net profit margin in the third quarter was 13.4%, which is not particularly high, but is still very solid from what it was a couple of years ago. Due to the problems in the supply chain, the cost of some components have increased by more than 100%, and the cost of freight has increased more than 8 times. But management has promptly reduced costs, which allowed the company to maintain quite a high gross margin. What we did is we made a lot of cost reductions over the last year, so we were able to absorb some of the cost increases. As we tried to absorb a lot of them, we're in a situation where we have to pass some modest cost increase, and I mean some modest price increase to the customers. Basically talking about how while they have tried to reduce the price for creating their goods, they still have had an increase in price when selling it to customers, obviously. Thanks to the economies of scale, the operating margin has grown steadily. Once again, as I mentioned before, as the company gets bigger, the price to compete and create its products will become cheaper as the company increases, and this has become a great savior, especially with the prices of a lot of shipping and, as we mentioned previously, components increasing quite significantly over the last year. The earnings before interest tax margin slightly decreased in the last quarter compared to the previous quarter as well. You can have a look at this graph, pause the video if you want to. So thanks to significant cost reductions in the last reporting period, the company was able to keep its gross margins relatively high. When supply chain problems are a thing of the past, the Enphase gross margin will increase significantly. We expect Enphase to improve margins in the long term through management's ability to respond quickly to business challenges and maintain a high revenue growth rate, as well as further realizing the economies of scale. Amid problems with the global supply chain, asset turnover has decreased, now stands at 0.55. But from the second half of the fourth quarter, the company will increase prices of all of its products. Overcoming supply chain problems will lead to increased asset turnover and increased profitability in the future as well. An additional hidden driver in turnover growth is a record balance of total cash and investments, which is 62% of total assets. If liquid assets are used to pay off debt, the asset turnover will rise by 0.3 points to 0.9. The asset to equity ratio is 3.4, the company's ROA is 9.1%, and the return on equity is 25.5% as well. We'll be looking at their balance sheets, comparing First Solar and Enphase's balance sheets later in the video as well. And as asset turnover increase, the ROA will grow as well. So you can just have a look if you want to. If you want, I can post a link of this website later on. It just goes a little bit more into the financials. The last thing we're going to be looking at is some risks. California has the most significant demand for solar panels, which is driven by their subsidies, and there is a risk of canceling subsidies in the future if political leanings shift, reasons within bureaucracy and regulations could shift subsidies in the future, which is a risk that Enphase needs to face. Removing incentive policies will increase the payback period for solar panel investments, which will lead to a significant decrease in demand. There is a risk of the company falling behind the solar energy industry if disruptive technology emerges, and since the industry is relatively young and has a reasonably low IRR, this may affect the current players in the industry as well. And probably the biggest risk right now is that insiders have been selling stocks throughout 2021, which is not a good sign for the company. However, we do not rely on only one transaction factor, but we recommend making decisions by looking at the picture of the company as a whole. We've seen certain insiders sell thousands and tens of thousands of shares over the last year or so. So the conclusion, despite COVID-related global supply changes, Enphase Energy posted record results. Enphase Energy has several essential growth drivers, and we expect significant growth in margins and recovery in asset turnover in coming years. We expect that the company will continue to grow and improve its profitability. However, Enphase is trading quite near fair value, and overall they are neutral on Enphase. The next one is we're going to be looking at First Solar, and this is once again an article on Seeking Alpha, and it reads that First Solar's push into India could be a game changer. So the summary of this article is that First Solar is expanding production to India, and they are building a new manufacturing facility in late 2023. The company stands out as a primary challenger globally to the Chinese dominance in the solar panel industry. It has a very strong balance sheet, it has a profitable operating business, and leading fully integrated patented photovoltaic technology are reasons to consider ownership. Past oversold conditions with sizable percentage declines witnessed in November-December, what we were looking at back here, with First Solar dropping about 27% over the past few months, have proven a good time to open a position. So the thesis. So First Solar recently just received an approval for a $500 million low-interest rate U.S. government loan to build a $700 million panel manufacturing facility in India. And why is this a big deal? For long-term investors plus utility and business solar farm buyers, it brings a new panel to supply options in Southeast Asia and Australia, who would like to not be dependent on China's leading global, almost monopolistic silicon panel production. It also represents a substantial portion of the company's effort to double worldwide production volumes by 2024. If you think ahead a year or two, what if increased trade friction between India or China, or places like Thailand, Vietnam, or Indonesia, or China and Australia heats up? Wouldn't high quality, low cost solar panel supplier manufactured outside of China be the best position to benefit from tariffs, business boycotts, and government mandated rules on Chinese made green energy product? The new India facility, which with a fully integrated photovoltaic thin film solar module manufacturer, is slated to begin production in the second half of 2023. So take this from their July earnings release. The planned facility is projected to have a nameplate capacity of 3.3 gigawatts DC. With First Solar's expansion in the United States and India, the optimization of its existing fleet, and the company anticipates that its nameplate manufacturing capacity will double to 16 gigawatts DC direct current in 2024. Unique among the world's 10 largest solar manufacturers for being the only US headquartered company and for not using its crystalline silicon semiconductor and for not manufacturing in China, First Solar produces its thin film PV modules using a fully integrated, continuous process under one roof and does not rely on Chinese crystalline silicon supply chains. The company's eco-efficient module technology uses its proprietary CAD-DEL semiconductor, has the lowest carbon and water footprints of any photovoltaic module available today. So basically looking at their integrated manufacturing process, you can just read through this as we go down. So the sustainability value offering that they have the lowest environmental footprint. They have 6 modules are the world's first photovoltaic product to be rated in the Electronics Product Environmental Assessment Tool for sustainable electronics. They have an industry-leading module recycling program which recovers over 90% of semiconductor and glass used in its module, and they have committed to powering 100% of our global operations by renewable energies by 2028. Looking at just some of their awards and recognitions and their next generation capacity expansion expectations as well. So the United States one, and they have the Indian facility as well, which would have 3 gigawatts by the end of 2024, 3.3 gigawatts in 2025. They have about 20 cents per watt. They have fleet leading efficient module wattage and environmental footprint. They have a low cost per watt. They have technological advances, domestic capacity, low growth policy as well, and they have benefits when it looks into tariffs and production linked incentives. So potential booking opportunities by geography. So we can see in North America currently they have 25.6 of their 49 gigawatts direct current opportunity, 17.6 in Europe, 17.6 in India, 0.9 in Europe, and 0.8 in other. And mid to late stage opportunities, majority once again in North America, with smaller chunks in Europe, India, and other. So what are some risks or what are some negatives that are holding First Solar back? In September of 2020, the company's largest shareholder, Lucas Walton, announced he was selling and donating a vast majority of his position. The announcement included his intention to remain a major owner with still a 5% stake in the company. Wall Street read his liquidation as a reason to lower optimism, and as such, First Solar was only a minor participant in the huge solar equity rally between 2020 and early 2021. Unfortunately for First Solar, a number of headwinds to US solar panel demand have dragged down the stock since November. 2 decisions by the US Commerce Department refusing to open a new probe of unfair Chinese dumping, and another US trade court on eliminating a 3% tariff on Chinese imports means that lower cost competitions from Chinese photovoltaic production chain will stay in place next year. Basically, they're losing market share to China's cheaper energy sources, basically. Reduced tariffs and growing supply of Chinese product could undercut some businesses on a price considerations by customers looking at First Solar's proprietary panels versus the more generic China's produced silicon-based panels as well. And on top of that, the Build Back Better plan has scaled down and may not even pass the Senate in terms of support for green energy initiatives, which will cut down a lot of subsidies that companies like First Solar would have received. So what the positive long-term valuation? Before the early winter bad news from the US government indecision, tariff rollbacks and tax filing policy, First Solar was actually performing well for investors with a peak of $123 per share in early November. The author's technical systems were actually quite bullish on the solar industry, and the author wrote a piece on ReneSolar on that link. So First Solar is an interesting choice of the sector from its unique patented technology for panels manufactured from start to finish in-house, its solar plant building expertise for customers, and a record of stable cash flow generation, and the strongest balance sheet in the industry, usually holding more than $1 billion in cash and short-term investments. Wall Street is projected a weaker 2022 for operating profits as expected below. There is said to be a dip in 2022 and 2023 for annual earnings per share estimates. But trading this company over the years, the smartest time to open a position has usually proven when analysts are not very optimistic about the next 6 to 12 months. The latest down cycle may turn out to be a similarly bullish movement to acquire shares if you can wait a year or two for your profit. The next thing we're going to be looking at is just quickly Enphase's and First Solar's growth sheets. We can see Enphase's earnings per share has increased quite well over the last few years, going from negative to finally hitting a positive in 2019. Compare that to First Solar, they hit their positives quite earlier, but their earnings per share has remained quite a lot more volatile. Looking down, see the book value per share has been increasing, once again a good sign. Their net margin has finally come in the positives as well, but they have reduced over the last few years. The return on equity has been quite high, 3 years of consistent positive with 115%, 35%, and 31% for the trailing 12 months, with quite a low interest coverage. Once again, not a good sign, but not too bad for the company that is looking to grow. Looking for First Solar, we can see their book value is a lot more solid than Enphase's. They have an operating cash flow that has been growing, a good sign for the company. Their net margin has been increasing, but is still quite low. The return on equity is extremely low compared to Enphase's, but their interest coverage is quite higher, meaning that they have a stronger balance sheet. Looking at their price to earnings, we can see that Enphase's price compared to their earnings has risen faster. So over the past few years, Enphase's price has been grossly overshadowed their modest earnings in earnings per share increasing. However, looking to the future, we can see that the price to forward earnings is set to decrease, meaning that their earnings will eventually catch up to their current price, and at the same time, it will be cheaper than what they were trading at in 2019, with a high but not too high PEG ratio of 1.66. Compare that to First Solar. Just need to go to valuation, have this load up. So just waiting for this. Once this loads up, just in the gap, if you're still watching, do consider subscribing. Like the video, it does help me out a ton. Okay, so here we go. So we can see Enphase's price to earnings has been quite modest over the past few years, has been trending downwards, basically showing that the company's earnings has been growing faster than their price over the past few years. However, their price to forward earnings is set to increase, basically talking about how their price is expected to outpace their earnings growth of the next few years, and their PEG ratio is much higher at 4.17. Just finishing it off with some technical analysis, we can see that Enphase has recently corrected, coming back down to its 50-day simple moving average. This has happened quite a few times over the past few years. The first time was probably back in November of 2019, once again rebounded. Then in March of 2020, with the whole COVID scare, once again rebounded. This time it was off the 20-day simple moving average in June of 2020. Then once again in September of 2020, it rebounded off the 50-day simple moving average in May of 2021, rose again, rebounded off that again in October of 2021, hit its peak of $280 and came back down to its 50-day simple moving average in January of 2022. And basically what we see here is that anytime it's hit its 20 or 50-day simple moving average, it has rebounded. This trend has consisted quite prominently over the last 3 years, so it's a very good sign to expect that Enphase is set to increase from here, and this is probably going to be the low point, maybe another 5% drop, but not too much lower than where it is trading right now. First Solar also has a very similar sort of chart. However, it has remained quite more volatile, especially in 2020. If we go back to the 5-year chart, we can see that it is currently trading below its 50-day simple moving average. However, over the past few years, it hasn't remained as effective as Enphase in following the trends. So there is quite a risk that First Solar will trade quite lower in terms of where the stock is heading over the next few weeks. So currently, if we're comparing Enphase and First Solar, looking at future growth, looking at their PEG ratio, and looking at their forward PE ratio as well, I would have to go with Enphase being the better company, and I feel like it has more room to grow in the future. First Solar is still a very solid pick, as so is Enphase, but I would feel like Enphase is a stronger company as a whole. If you want to invest in both of these companies, I would recommend some sort of ETF. There is the TAN ETF and the ICLN ETF, which are both heavily invested both in Enphase and First Solar. If I remember correctly, the ICLN has an 8% of its capital is in Enphase and about 2.5% is in First Solar. So that is a very good pick if you want to invest in both of these companies. But overall, I would pick Enphase over First Solar, looking at future growth, looking at their forward PE ratios as well. That brings me to the end of this video. If you did find it useful, do consider subscribing, like the video. Let me know what you think about these companies. If not, thanks for watching, and I'll see you in the next video. Bye.